Good day, everyone. I am Rachel Fami, and I am going to discuss the continuation of Chapter 9, which is Regular Income Tax, Inclusion in Gross Income. So, dito na tayo sa refund of non-deductible expenses. When we say refund of non-deductible expenses, these are expenses or payments which are non-deductible against gross income in the computation of taxable net income will never create tax benefit to the taxpayer. As such, the recovery should not be included in gross income. Hence, the refund of the following non-deductible items is not taxable. Number 1, Philippine income tax. Number 2, estate or donor's tax. Number 3, income tax paid or incurred to a foreign country if the taxpayer claimed a credit for such tax in the year it was paid or incurred. Number 4, stock transaction tax in the disposing stocks through the Philippine Stock Exchange. Number 5, special assessment. Reimbursements of expenses. Expenses of the taxpayer that are reimbursed or paid by the customer or client constitute additional income to the taxpayer. Examples. Number 1, when the lessee pays the ownership cost of the lessor, such as real property tax and insurance on the property, the payment constitutes income to the lessor. Number 2, when a client reimburses the out-of-pocket expenses of a professional practitioner, the reimbursements are income to the practitioner. Cancellation of indebtedness. The cancellation of indebtedness may amount to gratuity or payment of income. The cancellation of debt, letter A, in consideration of service or goods, treated as income. Letter B, as an act of gratuity, treated as gift, not as income. Letter C, as capital transaction, such as forfeiting the right to receive in dividends in the exchange of debt, treated as dividend income. Special considerations in reporting of gross income. We have number 1, accounting methods. Number 2, situs rules. Number 3, effect of value-added tax. Number 4, creditable withholding tax. Number 5, power of the CIR to redistribute income and expenses. Accounting method. The accounting method adopted by the taxpayer has a direct effect on the reportable amount of gross income subject to regular income tax. For instance, cash-basis taxpayers will report their gross receipts or collection as gross income, while accrual-basis taxpayers will report their revenue consisting of collected and uncollected income as gross income. It must be recalled also that regardless of the accounting methods of the taxpayer, advance income must be included in gross income in the period received. Situs rules. The situs of taxation also affects the extent of income included as items of gross income of the taxpayer. It must be recalled that all taxpayers are taxable only on the Philippine income except resident citizens and domestic corporations, which are taxable on global income. For taxpayers taxable only on Philippine income, only their items of gross income subject to regular tax from sources within the Philippines are included in gross income. For taxpayers taxable on global income, their items of gross income subject to regular tax from sources within and without the Philippines are included in gross income. Nomisma, a finance corporation, lends to various clients. Interest income from loans to Philippine residents, which is 400,000. Interest income from loans to non-resident clients, which is 500,000. Interest income from bank deposit in the Philippines, which is 20,000. Interest income from bank deposits abroad, which is 10,000. Required. Determine the total amount of gross income subject to final tax and the reportable amount of gross income subject to regular income tax. assuming the taxpayer is a number 1, non-resident foreign corporation, number 2, resident foreign corporation, number 3, domestic corporation. Solution. An analysis of the status of the above income is shown below. Loan interest income within 400,000, without 500,000. Bank interest income 20,000 within and without, which is 10,000. Total. We have the total amount of 420,000 in within and 510,000 in without. The following are the amounts subject to final tax and the amounts to be reported in gross income subject to regular income tax. In final tax, we have number 1, non-resident foreign corporation, which is 420,000. Number 2, resident foreign corporation, which is 20,000. Number 3, domestic corporation, which is 20,000. In regular tax, non-resident foreign corporation is 0. Resident foreign corporation is 400,000. Domestic corporation is 910,000. Note: number 1, non-resident foreign corporations are subject to final income tax on gross income within. Philippine residents shall withhold 30% final tax on their gross income. Number 2, the interest income from banks in the Philippines is an item of gross income subject to 20% final tax. The gross income subject to regular income tax of resident foreign corporations includes only those earned from sources within. Number 3, income from sources abroad, passive or active, are subject to regular income tax for taxpayers subject to tax on global income. The gross income of domestic corporations includes items of gross income subject to regular tax from sources within and outside the Philippines. Thus, 400,000 plus 500,000 plus 10,000. Effects of value-added tax on reportable gross income. Remember that business taxpayers are required to either register as letter A, VAT taxpayers if their sales or receipts exceeds 3 million pesos in the last consecutive 12-month period. Letter B, non-VAT taxpayers if their sales or gross receipts is below the VAT threshold or are specifically designated by the law to pay percentage taxes. Every VAT taxpayer is mandatorily required to charge 12% output tax on their sales or receipt. The regulation presumes that the amount charged to customers is inclusive of the 12% VAT. The output VAT will be paid to the government net of the VAT paid by the taxpayer or input VAT on his purchases. As such, the amount of reportable gross income shall not include the output VAT. Illustration 1. VAT taxpayers. A VAT registered taxpayer charged 78,400 to a client for rental. The VAT taxpayer shall split the billing as follows. Rental income. Yung 78,400, i-divide natin siya sa 112% equals 70,000. Plus output VAT, 78,400 times 12 divided by 112 equals 8,400. Invoice price with the total amount of 78,400. Only the rental income is subject to income tax. The output VAT shall be recorded as a liability. The collection of the rental is recorded in accounting as follows. Cash, 78,400. Rent income, 70,000. Output VAT, 8,400. Illustration 2. Non-VAT taxpayers. A non-VAT taxpayer charge 78,400 to a client for rental. Non-VAT taxpayers are not subject to VAT. The entire amount they charge for their sales of goods or services is gross income subject to income tax. Creditable withholding tax. Creditable withholding taxes or CWT deducted by income payers against the gross income of the taxpayer are not exclusions in gross income. This should be added back to the reportable amount of gross income. CWTs are tax credits that are deductible against the annual income tax due of the taxpayer. Illustration. Denso Incorporated, a non-VAT domestic corporation, reported the following. Rent income, net of 5% or 25,000 CWT, 475,000. Professional fees, net of 10% or 40,000 CWT, 360,000. Interest income, net of 20% final tax, 40,000. Dividends from a domestic corporation, 10,000. Business expenses, 500,000. Required. Determine the total reportable gross income and the income tax due and still due under the regular income tax. The total reportable gross income shall be rent income, 475,000 divided by 95% or 475,000 plus 25,000. It is equal to 500,000. Professional fees, 360,000 divided by 90% or 360,000 plus 40,000. It is equal to 400,000. Total gross income with the total amount of 900,000. Note: the interest income and the dividend income are subject to final tax. They should not be included in the item of gross income subject to regular income tax. The income tax due and still due shall be determined as total gross income, 900,000 less allowable deductions or business expenses, 500,000. Taxable net income, 400,000, multiply corporate tax rate, 30%, income tax due, 120,000, less creditable withholding tax, rent, 25,000, professional fees, 40,000, 65,000, income tax still due, 55,000. Note: the CWTs are actually advances to the annual income tax due of corporations and individuals and are deductible. Example, creditable. Thereto, same procedures are applied with individuals except that their income tax dues are determined by progressive tax rates. Number 2, the final taxes should not be credited against the annual income tax due. Creditable withholding tax and VAT. VAT taxpayers shall revert back to gross income amounts of withholding tax but excludes therefrom the amount of VAT charged to customers or clients. Illustration 1. A VAT taxpayer collected a total of 55,000 cash for services rendered, net of 1,000 withheld tax, but the client evidenced by a VIR form 2307. The VAT taxpayer shall compute his service income subject to regular tax as follows. Cash received, 55,000 plus withholding tax, VIR form 2307, 1,000. Invoice price inclusive of VAT, 56,000 less output VAT, 56,000 times 12 divided by 112, 6,000. Service fee, gross income, 50,000. Illustration 2. VAT taxpayer collected 85,600 rental from a lessee who withheld 5% creditable withholding tax. The VAT taxpayer shall compute his rent income subject to regular tax as follows. Cash received, 85,600 divided by 100% plus 12% minus 5%. It is equal to 107%. Rent income, 80,000. The VAT and withholding tax are as follows. Rent income equals 80,000 plus output VAT, 80,000 times 12%. It is equal to 9,600 less withholding tax, 80,000 times 5%, 4,000. Cash payments to the lessor, it is equal to 85,600. Power of the CIR to redistribute income and deductions. In the case of two or more organizations, trades, or businesses, whether or not incorporated, and whether or not organized in the Philippines, owned or controlled directly or indirectly by the same interest, the Commissioner is authorized to distribute, apportion, or allocate gross income or deduction between or among such organization, trade, or business. If he determined that such distribution, apportionment, or allocation is necessary in order to prevent evasion of taxes or clearly to reflect the income of any such organization, trade, or business. Section 50 NIRC. The problem of unfair pricing between associated enterprises. There is a risk that the pricing of the transfer of goods and services between associated enterprises will be controlled in such a way to further the interests of the associated enterprises as a whole in disregard of their social responsibility on taxes. Example, Mr. Wais has a business enjoying a tax holiday under an investment promotion law. Mr. Wais also has a business that is subject to regular income tax. Mr. Wais orders his taxable business to sell goods and supplies at cost to his exempt business, thereby shifting the profits to the exempt business to save from income tax. The transfer pricing guideline. Those enumerated scenarios are just a few of the problems in taxation brought about by unfair pricing practices. To limit these unfair practices and to properly reflect the income of associated enterprises, the BIR and the Department of Finance promulgated Revenue Regulations Number 2 Series of 2013 or RR2 in 2013 on transfer pricing. What are associated enterprises? Under RR2 2013, two or more enterprises are associated if one participates directly or indirectly in the management, control, or capital of the other, or if the same persons participate directly or indirectly in the management, control, or capital of the enterprises. Associated enterprises are also called related parties. Examples of associated enterprises. Number 1, parent corporation and its subsidiary corporation. Number 2, sister companies or businesses owned by the same parent corporation. Number 3, all corporations controlled under the same holding company. Number 4, businesses owned by the same person. The arm's length principle. Under RR2 2013, transfer pricing between associated enterprises shall be made under comparable conditions and circumstances as those entered into between independent parties, where market forces drive the terms and conditions of the transaction rather than being controlled solely by the reason of special relationship between the associated enterprises. In other words, an uncontrolled pricing between method determined by pre-market forces, also called arm's length pricing, is preferred. The failure to comply may expose the taxpayer to a transfer pricing adjustment where the BIR recomputes the proper income of the associated enterprises. The arm's length principle shall be applied to number 1, cross-border transactions between associated enterprises. Number 2, domestic transactions between associated enterprises. When operations are conducted cross-border, the taxpayer may enter into an advance pricing agreement with the BIR where a pricing rate is pre-agreed to apply for a period of time. Although this is not a mandatory requirement, this may serve as a safety net for the taxpayer to avoid the risk of transfer pricing examinations and adjustment and the inconvenience it may possibly cause. Transfer pricing methods. When the pricing methods between associated enterprises do not reflect arm's length pricing, the BIR will adjust the controlled transactions to their arm's length, using the most appropriate of the following method considering the circumstance of the taxpayer. Number 1, comparable uncontrolled price or CUP method. The transaction is valued in reference to the amount charged in a comparable and controlled transaction under comparable circumstances. Number 2, resale price method or RPM. The transaction is value based on the function performed by the reselling party to the product. This is used when products purchased from a related party are resold to an independent party. Number 3, cost plus method or CPM. The transaction is measured by valuing the function performed by the supplier of the property or services. Number 4, profit split method or PSM. The profit or loss on the transaction is split based on the division of the profits or losses that independent enterprises would have expected to realize from engaging in the transaction or transactions. Number 5, transactional net margin method or TNMM. This is similar to the cost plus and the resale price methods in the sense that it is uses the margin approach by reference to the operating profit earned in comparable and controlled transaction. When no comparatives can be derived within the industry of the subject taxpayer, the BIR may consider letter A, extension of the transfer pricing methods using comparatives derived from another industry segment. Letter B, use a combination of the transfer pricing methods or other methods. That's all. Thank you.